Hello and welcome to the Three Questions podcast, where we dive deep into the world of wealth management and connect you with industry experts. I'm your host, Wayne Baxter, Senior Executive Manager at One Capital Management. Now, if you or someone close to you is a cross-border investor concerned about how oil market volatility and geopolitical tensions in the Middle East could affect your retirement income, portfolio stability, and overall wealth management strategy, stay tuned. This episode is definitely for you. Our topic, the 3 questions cross-border investors should ask about oil price volatility. Thank you for taking time to check us out. And if you enjoyed this episode of the 3 Questions podcast, please consider liking this video and subscribing to our podcast and YouTube channels. Geopolitical tensions in the Middle East, particularly involving the conflict in Iran, have once again pushed oil prices into a volatile range. For high net worth investors, many who rely on portfolios for retirement income or to have significant exposure to both U.S. and Canadian assets, this volatility raises questions about inflation, recession risk, sector rotation, and long-term portfolio resilience. We're going to explore today how you may be impacted as we address the 3 questions cross-border investors should ask about oil price volatility. Joining me once again on the 3 Questions podcast is Steve Cowley. He is the Chief Investment Officer here at One Capital Management. He's also the Chairman of One Capital's Investment Committee. And all that, he's also a Chartered Financial Analyst and a member of the Los Angeles Society of Financial Analysts. Steve, it's that time of the year. We got to get together for a review, just like I'm doing with my clients now. We're doing a review as well. Great to see you. Thank you for making time.
Always great to see you, and we always have great discussions when we get together.
I'm looking forward to this one. We got, they say nothing ever stays the same, right? Time passes and things changing and changes. And before we get into our topic, we're going to be talking a lot about how the oil, and like again, this is such a fluid situation. We're recording today, and we're gonna. This episode will be posted in a few days from now, not that long. And between now and the actual day we post, who knows what will happen in that window. But before we get to that, let's just take a look back at the first 5 months of this year. And for you, I know we got what's going on with over in the Middle East, but what for you has so far stood out? And thinking back to where we from Jan 1 to mid-May, we'll say.
Well, I'm going to go back just a touch further back to November.
Fair enough.
Me, I always like to throw a curveball in at you. But because it's a carryover that what happened in this for 5 months, that's why I bring it back.
Sure.
So if we go back, to late November and December, we had kind of a sell-off in the AI stocks. A lot of concern about was there overspending in AI. So the stocks kind of sold off, and then we came into the year and we kind of forgot about that. I shouldn't say forgot about that, but we worked through the issues and we said, wait a minute, this is a big deal. The infrastructure spend is going to continue. AI is making a big
difference. There's a massive amount of money that's being spent on AI. People can't forget.
Absolutely.
Like the cap spend, as they call it, the cap rates are going to be pretty substantial going forward.
Yeah, we're talking hundreds of billions and even up into the trillion type range. So what surprises me is that we reversed that only to run into the Iran conflict, which then flipped everything on its head. It changed oil prices. It changed the notion of inflation. We're going to talk about inflation with our podcast today, and I'm going to take a little different tack than most people you're hearing are going to say on that. But that was obviously the shock that we had that. But the bigger shock is how disciplined oil prices have been and how quickly the market reacted and rebounded. Mid-March through May. I mean, it's truly amazing what the markets have done. So when I look back at the first 5 months, we're going to talk a little bit about this, a little bit of deja vu from a year ago.
Yeah, 100%. Like what I find really interesting is that in both 2025 and 2026, so far, I know we don't know where we're going from here on, but from the S&P 500 literally bottomed out pretty much on the same date, March 30th, in both years. I mean, you can look at it you track it along. It's almost the bottom for both years and for completely different reasons. The first one was the tariff, worries about
Right.
what's happening with Independence Day, but now this. So I found
Liberation
that rather
Day.
interesting. I don't
Yeah.
know if that was could be me being
Well,
amused by shiny objects here, but
yeah, and the thing that's interesting about both of those, and again, interesting is in the Chinese sense of may you live in interesting times, which is a Chinese curse, um,
yeah.
is that both of them were self-inflicted by the same person. So Liberation Day came around.
Not that did
We
not
had
escape me,
this.
by the way.
Bombs flew almost a year later. I don't know what it is. Maybe he likes to have the conflict in the first part of the year, so at the end of the year it looks better. I don't know what's going on, but both times
That
it
would be
was
pretty
it was a
calculated.
self-inflicted, correction in the marketplace for totally different reasons. And I'll say the Liberation Day was an overreaction. The Iran one, has actually been a surprisingly muted reaction, especially in the oil market. So a lot happening there. Regional conflict that has ramifications across the globe.
One of the more curious aspects of this increase in oil prices, Steve, has been the fact that the Canadian dollar has pretty much remained range bound. Now, my question to you is, I get just picking your brain on this one. Is this because the increase in the price of oil this time around is more about a supply issue than an increased demand issue? What's your thoughts on this?
That's part of it. I think the other part of it is that the Canadian dollar and the Canadian economy is so tied to the U.S. Markets, and we're right in the middle of the USMCA negotiation. The exports to the U.S., especially in the auto industry, has been really, really weak. You've got weak housing market in Canada. You've got, there's a lot of things that are happening in Canada that have weakened the economy again, that should strengthen. And I think that's actually kept the Canadian dollar down more than it would have if we normally saw this type of prices. So I think it's a combination of what you said, supply and demand. It's a supply shock, not a demand curve. But I think there's some other factors going on in Canada that are kind of muting the Canadian dollar strengthening. I think if we had a USMCA deal, I think if we had cross-border, manufacturing going as normal, I think the Canadian dollar would be stronger, especially in a situation like this where oil is as strong as it is.
I was talking to somebody actually, literally, I guess, about an hour ago, an M&A attorney, believe it or not, over on the west coast of Florida. And we were talking about a bunch of things that we're working on in Florida these days. And we did literally during our conversation, did a quick analysis, and I showed her that the purchasing power parity between the two currencies right now, there's about a 12% difference between the Canadian and US dollar. In other words, Canadian dollar is 12%, the purchasing power rate is about 12% lower because the Canadian dollar is at 73 cents. US and purchasing power parity is at 83 cents. So if you sold Canadian dollars today, you would be giving up basically 12% of the purchasing power of that money going forward. So, which is why, one of the benefits that we can provide here at One Capital, and thanks to you, quite frankly, is that we can manage Canadian dollar denominated investment accounts here in the US. So, but the thing is, we don't know what's going to happen, a year from now. We could see the Canadian dollar. It's not out of the question. You can't envision it right now,
Right.
but it's not out of the question. We could be sitting here and a Canadian dollar could be hovering up around close to 80 cents again.
Yeah.
So if you're holding Canadian dollar securities now in Canada and you're moving to the US, or you've inherited money from Canada and you're living in the US, selling into the US dollar right now, to me, I think would be ill-advised, especially if you have the option of
Right.
investing in CAD, because I said it could be a year, it could be 2 years from now, it could be 3 years from now, but the Canadian dollar could again go up closer to, I'm not going to say par. I'm not saying a dollar for a dollar,
Right.
but it's not out of the question we could see an 83-cent dollar again.
No, not at all. And the way you look at it with that purchasing power parity, that's really the way to look at it. And when it's out of balance, Yeah, one is cheaper than the other, and you lean into the cheaper. I mean, it's
Right.
investing, buy low, sell high. You lean into the cheaper currency, and that's exactly what we try and do. And
Yeah.
by looking at it in the right way, which is purchasing power parity, not hard dollar for
Yeah,
dollar,
like we did back when I
looking
was
at
a kid, my parents would talk about, the Canadian dollar is now a par with the US because it's a dollar for a dollar. I mean, not looking at them that way, but just in terms of purchasing power parity. Yeah.
right.
Just one other thing I was just thinking about. Do you think there's for Canadian energy companies, is there, from you as a portfolio manager, 'cause I know you're always looking at opportunities. I sent you something yesterday on that note regarding
Yep.
real estate. I don't know if you saw my email on that. But do you see an opportunity here for Canadian energy companies because of what we're seeing with, obviously their exposure, obviously the commodities? Is there an opportunity there, do you think, or just what's your take on that?
Yeah, I think the opportunity is um, longer term, and I do think there's an opportunity. I think it's longer term. I think it's structural as well. I think that the real opportunity for Canadian energy firms is a little bit of change of policy up there. I don't know if that's going to happen with the current administration in Canada, but to get not only pipelines to the U.S., but to take the pipelines to the coast so you can increase your export
Which coast?
capabilities.
Which coast are we talking here?
Well, I think if you took to the East Coast, which makes a ton of sense, to especially oil, because remember, we've had this conversation before. Most of the Canadian gasoline on the eastern coast of Canada comes out of U.S. oil refineries, and almost all of the oil and gasoline on the western half of Canada comes out of Canadian refineries and Canadian oil. And if they would take those back east, you could replace U.S. oil that's coming out of Pennsylvania and some of those places with Canadian oil. Um, and you could create export markets. And especially if you can get natural gas over to the East Coast, put in an LNG plant and export that to Europe, it's a real, like I said,
So,
there's
so,
a
so you're,
ton of
so
potential
you're,
there, but their longer term potential, it's not just the oil price and the oil shock. Canada has a tremendous opportunity if they would just take advantage of what's available to them.
So you're saying literally put pipelines all the way from northern Alberta into eastern Canada, like into the.
Yeah.
Oh boy, that's big time American thinking there, Steve. I
Well,
wonder. I
and I
don't
hate
know.
to.
I'm struggling to imagine that will happen in my lifetime, but it would
Yeah,
be.
I'm not expecting it. But if they take it west, which they've already done, and they just increase that, they could do. Because again, exports into the Asian market would be a tremendous boon as well. I mean, most of the oil comes to the U.S. And if you could create a diversity of stream of where it goes, it just is going to help those energy companies. But there's, like I said, yes, there's opportunity, but not necessarily because of this shock in oil prices.
All right. Okay. Bigger picture stuff. Okay. So, Steve, it's time for us to get to the 3 questions cross-border investors should ask about oil price volatility. So let's get at it here. Question number 1. I just recently retired and will be relying on my investments to provide the monthly liquidity required to live comfortably. I'm concerned about how the conflict in the Middle East will impact my investment strategy. Is oil volatility an inflation problem, a recession signal, or is it both? Steve, over to you.
I'm going to say both and neither.
Oh,
So
perfect.
I told you this
That's
podcast.
definitive.
Exactly. I told you this podcast was going to be a little different than some of
Okay,
the ones that we've
well,
done in the past. But it's so if we look at what's happened again, so it's a great question because you know, I'm retiring. I'm worried about my investments. What is this signaling? Is it signaling a reset? Inflation, is inflation going to lead to central banks raising rates, pushing us into a recession? I mean, all those are really good questions. And I would say in normal times, I might agree with that those would be a concern. The reason I say and neither is because this is a very unique situation. Like we talked about a little earlier, it's really a supply shock, but it's not a supply shock in the sense that the suppliers have shut it down. It's that a war and a Strait of Hormuz has shut it down. But there are other avenues where it's going and where it's coming from. And so It doesn't need to be inflationary, nor does it need to be recessionary. And we'll get into that a little bit later with some of the other questions that we're talking about. But so, and now you can look back at we talked about what the first 5 months of this year done. It's been an amazing run in the markets. And so, in spite of all of this, I'm retiring. I'm actually better off today than I was at the beginning of the year, and actually pretty significantly better off than I was at the beginning of the year. So those concerns, while valid, have played out, and they're showing that they're not. It's not playing out in this environment for that, and that's why I say this is a unique situation, and we'll kind of get into that a little bit more as we go on.
So when oil spikes, and again, from a portfolio manager perspective, when oil spikes, what matters more to the markets, the price of oil itself or what it signals about the global growth, the global economy?
I think in normal times, it's the signal that is giving us more than the
It's
price.
the anticipation. It's like
It's
what's
the
happening
anticipation,
next.
and it's why is it happening? Why did the prices go up? Is it because demand went up? Is it because supply was cut because of, again, not because of a war or Strait of Hormuz, but did, is the oil, because we talk about this in Canada and US and everywhere, is, you drill a well and you pump the oil out of it, and there's a diminishing return on it. You pump it all out and okay, now I got to go find more oil. So it depends on why the price spiked. If it's because all of a sudden the supply is shrinking and we're not finding enough of it, that's a different signal than a supply shock like this is, which has nothing to do with the supply levels and quantity, and more with just what's happening in a relatively short period of time. Again, it's been longer than anybody expected. It's been longer than we hope, but it's still a relatively short period of time. And even if this thing drags on until August, it's still a short period of time in the big picture. I don't expect it to go to August, but if it does, we have to think perspective and relativity, and even that would be a short period in the big picture.
Just one thing just to sort of move on, before we move on and just consider the question, at what point does oil stop, the price of oil stop being inflationary and start becoming a recession problem? Like when do you, as a money manager, saying, okay, this is now moving into, we got a problem here?
Yeah, and that's actually really the meat of what we're talking about here. And I'm gonna this question I'm going to take a little bit of time to kind of flesh out, and it's going to go in a little different direction than a lot of people talk about.
Fire away, my friend.
Because historically you would look at an oil price, and say at 130, 140, 150, it's inflationary and it's now choking off the economy. And I agree with that. This oil shock, and this kind of gets to it, if this thing extends past the end of June, and we start getting, really drawing down on the storage capacity and the storage reserves that are around the globe, and oil goes to $150 to $200 a barrel. Now you're getting into that recessionary period, not because the price is higher, not because of it, it's because you just don't have enough. You don't have enough oil and you don't have the energy to transport things around the globe. And now you start saying, okay, what do we have to cut back on because we don't have enough energy? So at that 150 to 200, if it extends a long period of time and it gets elevated like that, now you're talking about recessionary concerns. But the reason I kind of say that, and I'm going to be a little bit more long-winded in this answer, is because there's a lot of talk right now that oil prices are inflationary and they're leading to recessionary. It could be a recession coming because oil prices are up. I'm going to say it's lazy reporting on the media side. I think it's lazy on some of the economists, because they're talking about the Fed having to raise rates, and the Canadian National Bank raising rates, and the European Union raising rates, and everybody raising rates to fight inflation because oil prices have gone up. Now, typically, the reason oil prices go up in a normalized, market is because there's a huge demand for it and the supply is not keeping up, and the economy's heating up and it's growing faster than we would like. So we've got consumer spending a lot of money, we've got energy demand, we've got all these things that are heating an economy up and making it stronger. And so the central banks come in and they say, well, that's inflationary because we're running out of goods and services. And so we're chasing them. Now I have to pay more because I want to buy it and I don't want Wayne to get it. So I'll pay you $1 more than Wayne will pay you for it. And that's inflationary. And that's why I say it's lazy. That's a normal cycle. This is not a cycle like that. The economies they're not overheated. We don't have, we're not running out of people. Employment numbers are not going down. Again, usually when you have employment rates go down, it's because you have such a demand for workers that you're just hiring everybody up and all of a sudden the employment numbers slack off. I mean, we're full employment, but we're not running out of workers. We're not overheating an economy. Like all of the reasons to raise rates to slow an economy because inflation is manifesting itself, like none of that exists in this. And there's only a couple of people. And matter of fact, today I read another economist that agrees with me, and I was like, "Yay! I actually have somebody that's agreeing
Some
with me."
validation of your theory here.
It's we're looking at it wrong, and Warsh here, the new Fed chairman, he's not going to look at it. He's going to be looking at it a lot more the way I look at it. But I do think that European banks, who are, a couple of places have raised rates to fight inflation. They're doing it for the wrong reasons. This is not an overheated economy inflation. This is a single commodity price, which then of course goes into a lot of other things that's inflationary on that item. But if you look at, and again, if you look at the amount of like energy is, it's like 0.8% of the US GDP in demand. It's a small percentage of consumer spending. It's a small percentage of all those things. We notice it because we go to the gas station and we're paying, far too much for it. And it hurts the everyday and the everyman's budget because, now it's costing me more to gas my car. It's
100%.
more expensive. It's harder for me to go on vacation, all of those things. So it affects us, but it's not inflationary in the sense of it's a demand inflation. It's literally a supply shock inflation. And so like I said, I'm hoping that rational minds, and again, the market's showing that we're not going to see that. And when you look at you look at how the market is pricing things, and we talked a little bit about the Fed forward future rates on oil prices. That's the market looking ahead and saying, what do I have to pay for? I'm going to buy oil today, but for delivery in the future. And today's oil prices. Now we had some announcements that happens to be Wednesday the 20th when we're taping this.
Sure.
And oil prices have come down. But when I first put this graph together, oil prices were about 107. This is West Texas Intermediate crude. And if you looked out ahead to December of this year, if I'm buying oil today for delivery in December, the price I'm paying is only $85 a barrel. If I look a year out from now, it's $76 a barrel. If I look a year and a half out, it's back to 73. So that 85 to 73, that's the range we've been trading at pre this Iran crisis. So the reason I mentioned those future forwards is because the market and oil buyers, the people who like this is their livelihood, they don't expect this inflation, this oil shock inflation, to continue for very long. It comes off pretty sharply as soon as we get things moving forward. Again, it doesn't mean that oil flows immediately. There's going to be some lag to all of this. That's why the futures, it takes a while for them to get back to normal range. But the expectation is this inflation that we're seeing, this oil inflation, the expectation is going to go away just as rapidly as it showed up.
So, okay. So for the folks that are listening on the screen, because we're doing this on video, but on the screen, we have this chart that basically shows the future value of oil, basically just almost like a ski slope over the next year and a half. So from whatever point, because this could move out, we don't know when this is, we don't know when. So it could, in theory, we could be sitting here in July, Steve, and oil could be at $107 a barrel. It's in theory, correct? That's a
Right,
possibility. We don't want it, but that could happen. So
right.
you're saying that from whatever point in time this conflict is resolved to some satisfaction here, that's when that sort of
Yep,
ski slope will begin.
yep.
So basically,
That's
what
when,
we're looking, the way I would look at it is, from now, the futures are saying sort of an immediate down like that as of now, but we're looking at a year from now to the point where we get back to what we'll call normal gas prices. So basically moving it out from wherever we are when this all began, whenever that strait opens and the boats are going through and they're not worried about getting hit by incoming,
right.
drone
And that's
fire.
exactly, and that's why I said there are some, when we talked a little bit about Canada and the opportunities there. I mean, there's opportunities around the globe, not just in Canada, but Venezuela, a lot going on there, but Venezuela's got the second largest known proven oil reserve. It's not going to happen overnight, but if Venezuela will reopen and allow, foreign
Well, they have to
investment
have
in
the
there.
capacity. They need to have an infrastructure build there to make themselves
Yeah, well, and they've had it. It needs to be redone. It's like I said,
right.
these are longer term issues, but
Right.
this conflict, as bad as it is, and the choke off, it's really getting people like Canada, like Venezuela, a lot of other places to say, hey, we need to be able to ramp up oil production and get oil from other places so that not all of it goes through the Strait of Hormuz. And again, only 20% goes through the Strait of Hormuz.
But
There's
there's not
natural
just
gas.
oil though, Steve. There's other things too, like fertilizer, other minerals. There's not just oil. There's other things going
Well,
through there. But
well,
the
and
oil,
that's the natural gas that comes out of there. And again, with the U.S. just opened a new LNG facility this year. So right now, the U.S. is exporting. As a matter of fact, they're the world's largest exporter of petroleum products right now. The U.S. is. And again, it's because we're producing enough, and especially with Canada piping it down, we're producing more than we need. We're doing a lot of refining of capacity. We're liquefied natural gas. We have a tremendous gas in North America. You liquefy that, you put on a boat. You have to freeze it. You have to get it down to 260 degrees below zero to do that. It's very expensive, but we just opened a new plant, and that's going to be the supply that doesn't replace what's coming out of the Strait of Hormuz, but it's going to make it so that it's doable. And again, just like the pandemic said, hey, we've got to diversify where we get things. It can't all come from China. So because the supply chain got choked off so badly, we're seeing that again here. Supply chain is choked. Let's open up some of these other avenues and develop them. And so, like I said, I'm actually the future for oil and energy is pretty bright. We'll get through
interesting.
this. Yeah, we'll get through this. And I think in the next couple of years, we're going to actually, like we're going to have excess capacity, and we're going to have people actually, curtailing
But
what
you're
they're
going to tell
doing.
me you're giving me some assurance here that a year from now, when I go to fill up the SUV like I did last week, and it cost me $100, I'm not going to be paying $100 for.
No, you should definitely be paying less than that.
Well,
And now again,
I'm going to remember that comment.
I actually got a little smile on my face when you said that, because the oil companies are notorious for when oil prices go up,
Oh
the
yeah,
gasoline price goes up immediately. When
and
oil
when
prices come down, they
it
use
takes
the
a
excuse,
while.
well, I bought it at 100. I've got to work that through my system, and then I'll lower prices for you. So
Yes.
it's a game.
Thank you very much.
But
So
again, that goes back to your energy and is there opportunity. The stock prices of some of these things are going to be a little bit volatile because when oil prices come back down, they're going to fall off. But for the next couple of years, all the energy companies are going to make a ton of money. I mean, they are going to make a lot of money because of this supply shock.
our topic today is the 3 questions cross-border investors should ask about oil price volatility. And again, our guest is Steve Kelly. He is the Chief Investment Officer here at One Capital Management. He's also the Chairman of One Capital's Investment Committee. And as the saying goes, the buck stops with Steve on, for the clients of One Capital. He's the person who ultimately decides on which investments you have in your portfolio. Okay, Steve, let's go on to question number 2. With the ongoing conflict that we're seeing between the United States and Iran, which sectors and asset classes benefit the most and which become vulnerable? Perfect. Way to go, Steve.
And again, I'm gonna feed right back into what we were talking about with natural gas and agriculture and things like that. It's a benefit and it's a detriment. It's a benefit because these fertilizer companies and they're going to raise prices because they're having a harder time getting natural gas to produce the nitrogen and produce the fertilizer and things like that. So there's an opportunity there, but there's also a detriment because they're having to pay more for their feedstock. So it's kind of where you are within that supply chain. The guy who's selling it to my brother, who happens to be a fertilizer distributor, he's making a lot of money. And my brother can raise his prices. But the guy who's manufacturing it is going to struggle a little bit because it's costing him more for feedstock. He's having to pass that price on, things like that. It's going to hurt then the farmer down the road who's paying more for the. So again, it's kind of where you are in that supply chain as to whether you benefit or hurt by it. The other sectors, obviously energy, all the energy producers are benefiting because of the higher prices. The industries that are not, I'm going to say, hydrocarbon dependent are the ones that do a little bit better. I mean, we hear a lot in the news that it's going to hurt the consumer because, now again, it's hurting us because of gas prices. But they're going to say, well, everything's going to be more expensive. Food's going to be more expensive because it costs more to get it to the grocery store. It's a small percentage of the food price. It's a small percentage of all that stuff. So there'll be people that are hurt, but it's not going to be as damaging as people think to the consumer. Other than, like I say, gas price pump, that's one thing that everybody's feeling it immediately. But the food inflation is not going to be as bad, and we're actually seeing that. We've seen that with the March and April numbers. Food inflation is not nearly what they said. Garment manufacturing and things like that is not going to be. There's going to be an incremental cost benefit to that, but not much. Now, when you get to healthcare and you get to some of these others that are pretty cheap right now, and you get to financial services, they're not going to be affected by this. So it's not going to benefit them, but it's definitely not hurting them. Then you get to the world of AI, which we talked a little bit about, and the infrastructure build and all of that stuff. And there's a little bit more complex because the AI itself is not
There's
so
an
much.
energy component to
But
AI.
there's an energy component, and it's a big energy component. So once you flip the switch to that data center, it is a huge component of it.
No kidding.
So it's kind of one of those that the build, it's not going to hurt as bad, but the operation is going to hurt. So interestingly enough, AI is going to be not benefit from it, but it's not going to be, the build won't be hurt from it, but the operation will be hurt from it. But it won't last that long. It's not going to last that long. So it shouldn't be that detrimental to them.
So historically speaking, and you just go back over 30 years, I guess you've been a portfolio manager. Which sectors of the market typically tend to outperform during a period of sustained oil volatility? Are there any sectors specifically that sort of stick out to you? I mean, I know the oil energy sector, but are there any other? In addition to that, is there any particular sectors that you kind of think about? Wow, there's an opportunity there.
We're always looking for opportunities, and again, it's going to be kind of company specific within those industries because when you talk industry, like I mean, even in the pharmaceutical, where there's some feedstock that comes out of that, and the consumer, especially the garment and the makeup and things like that. You'd be surprised how much comes out of the energy sector on those things. I mean, nylon is a byproduct of oil, so those feedstocks, like that can hurt them and it can help them because they can raise prices on that stuff. So I wouldn't say the energy is obviously the clear winner. After that, you need to kind of go company specific and who's benefiting, where are they in the supply chain, that stuff. And we're always looking for those.
And again, and that's one of the things, the great thing about the way One Capital manages money is that we do purchase and sell individual names for our clients. We're not just recommending, brand X mutual fund or ETF. We're buying individual names for our clients' portfolios. So I guess to just one last thing on that point. Are there parts of the market that concern you the most? I mean, we were talking about optimistically about the other side of the coin. Are there parts of the market that concern you most if this oil volatility were to persist into next year, like not just for a couple months, but let's say we're sitting here February 2027. So, oh my God, this conflict is just not going away.
I'm going to say I'm going to be concerned about everything.
All right.
Because I think if this conflict and oil prices stay as high as they are, the supply chain shock is going to be enough to drive us into recession. It won't be a recession because we overheated and the central banks raised rates so much. I mean, this is a typical cycle. They raise rates too much, it chokes off the economy. We'll go into recession. They start lowering rates. In this scenario, I think central banks would panic, would raise rates, which is going to slow things down. But the cost, if we're at 150, because if we're sustained like that, Wayne, we're talking 150, $200 a barrel oil. Now, I think everybody gets, and we're talking about severe recession, and a real scramble to find alternative sources.
Okay, I want to say
It's not a good scenario. Don't stay on that one, Wayne.
Okay. So let's be pragmatic here. We have midterm elections coming up.
Yes.
And so let's just say that there is, I'm sure, a significant, I'm certain of it, amount of lobbying going on right now for this administration to find an off-ramp, because
Yep.
you wanna blow up real good come the Klinger frame from the Canadian SCTV here, for those who didn't recognize that. If you want to blow up real good, you keep this a conflict going on until next
Yeah.
right? So we know there's a lot of lobbying going on with the current administration to find an off ramp, we'll call it. So yeah, that would be something if we're still floundering away on this. And God,
Yeah. No, that's why, the probability of that is very, very low. I mean, you can't say it's zero, but it's really, really low because of all of the other factors. I mean, first of all, Europe, Asia, like everybody is being screaming for it as well, including the Middle Eastern countries that are our allies in this right now. They want to move their product. So again, this is why that forward futures curve is so steep on the downside, is because nobody expects it to go too much longer, because the unintended consequences get bigger and bigger and bigger the longer it goes.
All right. Okay, Steve, let's move on to question number 3. That was a fairly intense.
Yeah.
Really bad everywhere.
Yeah.
Okay.
I don't usually say that, that way.
Yeah, I know. You're a glass half full type of guy. So, all right, let's move on to question number 3. From March 30th of this year to April 15th, the S&P 500 gained over 15%. Given the uncertain times we are in, are markets underestimating geopolitical risk? Kind of in the midst of our conversation, but let's take the question. Your thought.
And it's kind of what we've been talking about. It's why the market has reacted as it has. Oil has stayed relatively, the discipline in the oil market has surprised me. So the answer is they haven't. The markets are not looking at a prolonged. They're really looking for a resolution in some way, and the markets have acted as though it's a done deal. They just don't know what that day is. Like you said, when we're looking at that, is it May 20th? There's some rumblings today. Is it May 31st? Is it June 5th? Is it June 15th? I mean, there is a date certain. We just don't know what that date is that this conflict is going to end. And we're all hoping that bombs don't start flying again. We're all hoping that there are no boots on the ground. Like all of those things, exactly. And it doesn't look like that. I had a conversation with somebody who's far more knowledgeable on military matters than I am, and those times have passed. Like, if we're going to put boots on the ground, we'd have to almost start all over again because you have to soften up something. Like I said, so everything is showing and everything is looking like there is a resolution. It won't be perfect for either side, but we'll get to a resolution, and it's just a matter of when, not if. And that's how the markets are reacting, and that's why they bounce back as fast as they can. The other thing is we've had a lot of economic numbers come in. The AI spend and the earnings have come in. The consumer has been far more resilient than we thought. So like I said, the economics, in spite of the oil shock, have been relatively strong. I mean, it's weakening the economy, but the economy is so strong, especially with the AI infrastructure build, with the productivity gap that we're creating with this. I mean, one of the things that's happening with this, and it's kind of why we've kind of rolled through this as well as we have, is since the pandemic and since we've also had a major export, if you will, and of people. So not immigration, but people are actually leaving this country. They're self-deporting, they're being deported, all those things. We've had a labor shrinkage, but we haven't seen a fall off in productivity. As a matter of fact, we've seen a pretty significant increase in productivity
this decade. So decade to date, I guess I'll say.
Yeah.
Has been the most productive decade compared to 2000, 2010. So we're seeing, and again, that's because you can thank all the R&D and all the
exactly, and that's pulling us through all of that. And so that's why, like I said, it's a great question, but I'm taking the prolonged off the table, but even with the other headwinds that we faced, the productivity cycle that we're just entering with AI and with all that, again, we talked about this before. It's just a tool. It's just a really powerful tool that's going to make us all better and more productive. And it's not going to take away jobs. It's going to take away jobs from some sectors, but it's going to create a lot of jobs in other sectors. There's going to be a shift, like there always is when we have disruptive technology and productivity enhancements like we're having. So, like I said, I can hardly wait till we're through this and we get through this oil shock thing, because the future looks really good. The future looks bright across the globe. The geopolitical is what it is. And Donald Trump is who he is. And like that's going to go for another couple of years, 2 more years. That's it. And but the underlying fundamentals are pretty good. And so, like I said, I say this all the time to people: put your blinders on to the geopolitical and the politics of it, because politics are divisive. Look at the numbers, look at what's underneath it, look what's happening, and talk to your neighbors and friends. Life's good. I mean, we're moving forward. It's a time of great productivity. It's a time of great enhancement of wealth that's growing. Like we're in some pretty good times. And so if we can just get away from the distractions, which is politics and the divisiveness, which can come with that, and we focus on what we're seeing and what's actually happening around us, we're in some pretty good times.
Okay, I got, we're just going to move on here. I don't want to keep you too long. So what does oil volatility tell us about the capital markets? Like you're saying, there's a lot of opportunity, a lot of optimism here. So your take on all of this is that, as a portfolio manager, you're looking at this as there's an opportunity here. I mean, I know sometimes I see you and I see other members of the investment committee. We run each other in the hallways here, and we have our own trading. Well, folks that have never been to our head office here, but we have our own trading floor. We do trade. We're trading from 6:30 in the morning at Pacific time to 1 o'clock Pacific every day, Monday to Friday. Like you're looking at this as a buying opportunity at this point in time. Am I here? Because I always say, I ask the guys, are we buying or selling today, guys?
Yeah.
And
and so now you're getting a little bit bigger picture of economy, and I'll be really quick because we don't have a lot of time.
I know we got to wrap up here, but just Cliff Notes version.
Yeah, so there's tremendous opportunity. Valuations are a little bit extended, so they're kind of at the higher end of normal. So it's not a time to just, close your eyes, back the truck up as we talk about. We have those opportunities from time to time. When it sold off in March, it was a time for us. We did a lot of rebalancing. We picked up some stuff. We made some changes in the portfolio. Right now is a time to be opportunistic in your buy. There's opportunity. There's a lot of things going on. These conflicts and what's happened has created a lot of opportunity in a lot of places. And so the answer is yes, we're buying, and yes, there's opportunity, but you have to be, right now, it's a selective period of time. You want to be smart about your buying. You don't want to just be, close your eyes and put the money to work. So make sure you have a good plan and that you're putting it to work in the right way.
Okay, I have one last question before we go.
Okay.
One last question. How exposed are the private credit and private equity portfolios to higher energy and transportation costs? I wanted to put that out there because I know we obviously our clients have exposure to private assets and
Right.
private equity, private credit space. So just real quick, like from your, you're talking to the folks at Wilshire and at Cliffwater and Numora. Like what are they saying about that?
So the exposure there is not great because they're really, most of these companies are established companies that are working. Again, it's like anything. If the investments in there in the private sector, if they're energy intensive, it's going to be a struggle for them. Most of them are more service oriented because the economy is more of a service economy. So most of them are more service oriented. There's a lot of technology within it. There's, as we've talked to, we have exposure to SpaceX in some of the portfolios. So it's the blend and the mix that's in there. So in the private credit, again, our private credit space, because that's a space I know, private credit and private equity space, there's not a tremendous amount of exposure. Again, if you get to that $150, $200 extended period, it affects everybody. Mm-hmm. But in a normal and what we're expecting, the exposure is relatively small. Now, again, there'll be other private credit and other private equity out there that tend to be more energy intensive, and there it's going to be a little bit more of an issue. But with what we've got invested, it's not really an issue. It's not something to concern us as well.
Okay, Steve. All right, we covered a lot as usual. I'm labeling this episode as must listen. Probably should put that at the beginning of the episode, but this is definitely a must listen for all One Capital clients, most certainly. But also to my friends and colleagues across the United States and Canada. This was a great episode. I thank you so much for making time for us today. And won't be long before I'll be dragging you back in here for another podcast. So thank you very much today, Steve. Really appreciate it.
You're more than welcome. It's always a great to share thoughts and have a discussion that we do. Like I said, it's a great give and take and back and forth. And you always ask great questions and you challenge me to make sure I'm thinking straight. So it's good. Thank you, Wayne.
Touche. Steve Calley is the Chief Investment Officer here at One Capital Management. He's also the Chairman of One Capital's Investment Committee. Thanks, Steve. We'll talk to you soon.
Thanks.
I look forward to bringing you the Three Questions podcast. I hope you find them educational and informative. Please consider liking this video and subscribing to our podcast and YouTube channel. And to receive a notification of when our latest episode has been posted, please click on the notifications bell. Last but not least, to schedule an online Zoom consultation with me to discuss your wealth management needs, please click on the link in the description box below, www.onecapital.com/meet with Wayne. Thank you, and we will see you soon.